founding, a co-founder at String Labs. So for those of you who haven't heard about String Labs, so String Labs is a team of engineers, researchers, architects, law professors, and et cetera, basically researching on open decentralized systems. So we work on a bunch of stuff, open financial systems, more network layer stuff, which you will probably hear some bit about from my colleague Timo Henk next week. So today we're going to focus a bit more on the business side, but kind of the new business models that's being enabled by the smart contract and DAO and all these kind of new constructs that you probably have heard of. Can I get a show of hands? How many people are like engineers that coded smart contracts or anything to do with that? Cool. How many people have coded smart contracts or familiar with smart contract coding development? Cool, quite a bit. All right. And any of you entrepreneurs looking to start a venture in decentralized space? Cool. All right. Very cool. Very good. All right. So let's start. So what is a protocol? So the term, we tend to hear a lot more about the term smart contracts, DAO, and other stuff. I kind of prefer the term protocol. We use that a lot in String Labs, just to formalize the exact concept of where you create something that kind of has a formal interaction system rule. And protocol is a pretty broad term, right? So there are different type of protocols. But this is what pulled from the dictionary.com, a system rule that explains the correct conduct and procedure to be followed in formal situations. And we use that as a base concept and build on top of it and see what can be done and what are things that are meaningful to be done. So there are different classes of protocols, and a lot of them are pretty old. You have, kind of traditional old stateless non-economic protocols, like BitTorrent, for example. They are complete peer-to-peer networks, but they doesn't have much economic properties. And then we have the crypto-economic network protocols, kind of network layer protocols like Ethereum and Bitcoin, et cetera. And then once you have that base layer, obviously you can build more fancy stuff that is on top of the network layer protocol. So we'll just call it open business protocol. It doesn't really mean it has to be corporate, but it's just general business protocols that contain certain business logic in it and state. And they're stateful, right? So Gnosis or supply chain systems. For example, a big Fortune 500 company could put their supply chain system completely encode the logic on a blockchain, right? So that's kind of protocols that we're going to focus on today. Now, if we think about what exactly are the interesting opportunity in the protocol space, so here's probably how we're going to structure today to talk. 3 parts. One is the opportunity. We're going to look at what our interesting way of looking at what are possibilities. The second thing is what exactly open protocol model is fundamentally or quite a bit different from traditional startup models that we think of them. And the third part is the laws and regulation that kind of quite interesting bit, given lots of protocol ventures are doing token creation or token distribution process. So that's a lot of legalities, which is kind of fun actually to research as an entrepreneur. So I'm not a lawyer, but I'm just going to share some of my personal research results for the last couple of years, basically. So if we think back about the promise of the internet, it basically promises more equalized economy, right? That's the beginning of the internet. But what we really see happening in reality is a much more nuanced reality. It's kind of in some way equalized economy, but if you look at, this is an interesting slide that I pulled from the internet, becomes quite popular, viral recently. The world's largest taxi company, Uber, doesn't own any taxi. The largest accommodation provider doesn't own any real estate. Largest phone company doesn't have any telecom infrastructure like Skype, et cetera, et cetera. And in general, you see a pattern of the most powerful companies today by market cap, by sales, by revenue, by employees, or actually doesn't really own any edge. They own the center of the net. They own the topology of the network, right? And in some way, we can think of them or conceptualize them, or are really protocol conduits, that basically they control the network and they profit with that control. So that's kind of interesting. And now the next question is how valid or how strong these business model defense are. Can we probably make them more efficient and with new blockchain constructs? So we start with the basic question. What are blockchain systems valuable for? That's a question we get asked a lot. We can start with that and we can refine that question over this talk. So the first thing, we generally can categorize the industry into 2 categories. The first type of business is blockchain companies who are enhancing automating trust for existing businesses, right? So you're a big Fortune 500, you heard of blockchain, you thought it's great. How can we use that to defend our business model? How can we use that to eat some of our shares and profits of our competitors or our higher level chain or our suppliers and vendors and save cost? That's the kind of thing you think about. From that angle, there are a couple of clear benefits. Shared certainty, finality, to a certain degree, tamper-proof more technically. Transparency, you got more transparency of all, for example, in the supply chain system, all the different vendors in the supply chain and the sourcer, the manufacturer, whatever, would see the same states, right? And they got transparency, understand the logic. By the way, there's one nuanced kind of differentiation between transparency is they're transparent to the state and transparent to logic. Today, we kind of bundle them into one, right? So you know exactly what exact data is being stored in state. You see every data, as well as the logic. In the future, with zero knowledge system and et cetera, it doesn't have to be. It can be unbundled, right? So you could have transparent logic, determinist logic, but not state itself. So there's less of a privacy issue, which is really important actually in business environment. Third thing, more robust, redundant network, more secure, interoperable, et cetera, et cetera. So that's kind of main thing. The downside, obviously, it's a bit slower and harder to maintain, to upgrade a network, as we could see with many things happening in public network. But even in corporate space, that also means it's a bit harder than just fixing a bug, and market is done in Jira. It's a bit more challenging than that because you have multiple participants in a federated consortium chain, et cetera. So with that, we see a number of interesting use cases that happened in the last 2 years. Private equity exchange in NASDAQ, for example, interbank settlements, syndicated loans, cap table management, and all of them generally, you can generalize them as a couple of characteristics. One is there are lots of party involved. For example, in a cap table, if anyone has done a startup or tried to register a company, you realize how incredibly stupid cap table are, right? Today, there's not cap table per se. There's lots of legal documents, right? And hundreds of pages of legal documents end up with basically summarizing who owns how many shares, which is a pretty simple equation. And you can obviously encode that business logic on chain. So for example, Delaware was piloting a private share kind of cap table management on blockchain in partnership with Symbiont. That's a simple example. It's not particularly fancy logic, but just a mere fact. There's lots of stakeholders. For example, any startup interacts with at any point 20, 30, 40 different investors, advisors, teams who all own a stake in the company, right? So that kind of thing simplifies logic. And everybody has the same state. I know exactly I put in $1, how many shares I'm getting. There's no room for fraud. So that's simple. And then asset exchange, trade financing. I'm not going to focus too much on this. So this is our generally incremental kind of models that are using blockchain to help them. I think it's interesting to think about, fundamentally, if we take one more step back, is all disruptive technologies in general provide different type of benefits. One, it helps existing businesses try to automate their technology stack, save cost. They can even consolidate. For example, if you're an exchange and you think about, okay, when I execute a Apple stock trading, it goes through 5 or 10 different layers, right? It goes through the E-Trade, for example, as a broker-dealer. Then it goes through E-Trade's broker-dealer's broker, which is prime broker. And then you go through an exchange like NASDAQ. And you go through DTCC, et cetera, et cetera. So there's lots and lots of layers. So each people, if you're one of the actors in these systems, your question is that how can I use blockchain to cut off the business of other people so I can save my costs, right? If I'm taking 25% of profit, maybe I can take 100% by just automating all their job with the blockchain technology. But the very different angle, though, is if you're a new startup, if you're someone just want to make a more efficient economy, create a more efficient economy, the question is, assuming none of that exists, can we create something that is completely new and peer-to-peer? So that kind of leads to the second type of categorization of opportunities in blockchain. We call them D-business, to be simple, decentralized businesses, and they're powered by open protocols. If you see from that angle, all these protocols are not necessarily benefiting existing incumbents. In fact, they might be disrupting the incumbents in many cases. These incumbents may not be very efficient. They may be there for a long time. They may be redundant, et cetera. So the benefits are mainly, first of all, it's ex-juris. It's outside any jurisdiction, right? It's not within any single jurisdiction. You don't conform. For example, if you do a payment company in the US, you need a bunch of licenses, money transmitter license, MSB. If you expand your market now to China, you have to acquire a new set of licenses. That's a traditional startup way of expanding by jurisdiction the market is. In the new kind of protocol world, you don't necessarily have the concept at a protocol level. You do have concept, obviously, of regulation at the edge, but you don't have so much of a concept of jurisdiction for the protocol. The second thing is you have the trust in codes that's shared with the private businesses, and it's permanent and kind of continuity. I don't know if it's the best term to describe it, but once you deploy a blockchain code on chain, it's there forever, right? Which is a very important thing when you position them as a public service. You don't want some service to go down because the developer forgot to pay for his AWS credits, right? That's the kind of thing, the permanency there. And of course, you have the global reach. If you're creating, for example, a financial system, you access to global capital, whatever is available. And finally, you have a bunch of tools that kind of create a stronger network effects that we're going to talk about today. The downside is there are some downside. When you create an open system, you have slower, harder change. It's also more complex social governance, as we can see with recent DAO or ETH versus ETC, all kinds of complexity you don't expect in a constrained system because it's now open. Everybody can impact how it works. So what does that lead us to? Lead us to a number of very interesting opportunities. So we can now refine the question. Previously we asked, what can blockchain system do? Now we can refine the question and say, if you're an entrepreneur and you're going to create a business with something to do with blockchain, you can refine the question to what type of business areas are generally slow to change in protocol or in interaction, but it benefits massively from global markets or trust or network effect or any of them. So here's a few indicators, probably something that's one area might be suitable for that. You look for large and commoditized business models, and with intermediary kind of model. You look for broken trust, meaning someone who is not doing a very well job in establishing the trust, yet they're still there, maybe because of regulatory hurdles or other reasons. You look for market incentive failures, meaning the business model they're doing today doesn't incentivize well people to do the right thing. They incentivize them to do the wrong thing, to exploit the system, which is very frequent in financial systems, right? In 2006 and 2008, the failure of the credit rating agency rating all the subprime mortgage loans improperly is one of the signal that probably the incentive is not doing pretty correct. It's incentivizing people to game the system. And there's also the example of overcomplexity. For example, the assets trading example that I just talked about is an example of it doesn't really need so much layers of intermediaries. It really just evolved naturally to be unnecessarily complex. And somehow they just be there. It's not because they're particularly advanced or complex or fancy. So if we look from that angle, there are a number of interesting examples that could lead us, and each of this angle would lead to different interesting opportunities. Broken trust, lending club. We're going to talk about a few examples that we're quite familiar with. Lending club, I suppose most of you heard of that. The kind of the frauds that are happening with lending club. The CEO being fired because they misused some of their funds into a CEO affiliated funds, right? A typical example of broken trust. Once you establish a brand, but you kind of abuse it. There's a more stronger example of that version of that, which happened in China. One of the largest scam ever, $7 billion in 24 months. So Yizhubao is a P2P lending platform. Was one of the largest. They were not really lending money, people to find out. They're really just paying executive bonuses, right? $1 million bonuses or something. They're misallocating lots of funds to movie businesses, lots of private business, et cetera. And it ended up with a $7 billion scam. It was supposed to be P2P lending that provides people higher interest, and that was basically a complete fraud. And then you have other type of thing, less of a fraud, but more excessive margin over complexity, over engineered. Which started with an interesting example is Uber. Like I started taking Uber in the last 4 months. I've been driving much. So I've been talking a lot with Uber drivers, and one of their major complaints is Uber charges way too much for their simple business model. They charge 25%, and if you think about $20, they charge $5. Out of that, they still had to use rest of the money to pay for gas, pay for insurance, pay for tons of things, right? You kind of wonder, why does Uber charge so much? Are they really that expensive to conduct a single transaction? Not much. And we'll look at an example how we possibly do that in a decentralized fashion. But that's an example of why they charge, they have excessive margin. The other thing is, broker-dealer. If you anyone did stock trade here? Can I show hands? Crypto trading? Notch. All right. So stock trading is interesting. If you do crypto trading on Poloniex, right, that's pretty low fee, generally pretty low fee. And a bunch of Bitcoin exchange even do 0 fees. But if you go to stock trading world, if Fidelity or any of the E-Trade, right, these exchanges they execute, first of all, they're really expensive, right? Every time you execute trade, you pay $10, $20, some discounted broker charge you $5. Like from an engineering perspective, you kind of wonder what exactly is happening in this, in that trade that makes it so expensive. Isn't it just a database update, right? It is, which is it is. It's only expensive because of so many intermediary layers. You go through 5 to 10 different layers that you didn't see. And on top of that, not only that, in fact, that's not even their main business model. The main business model is actually charging you on the settlement time. So when you execute, for example, you sell 100 shares of Apple, you got $10,000 back, and you want to withdraw the money to your account, you'll realize you at least have to wait 5 to 10 days, business days. What exactly is happening in that 5 to 10 days? It's because of T+3 settlement time, business settlement time. And what settlement means is the swap of securities and cash that is happening at their back end, right? So someone's name actually exchanged with yours in the broker's book. And in that broker, the broker would have to net with other brokers. And that brokering all the way go up to DTCC, which is kind of the final ledger for all these stocks and commodities. So there's a complex process going on. And people who are benefiting from that T+3 settlement time, it's mainly people who are holding your assets in between, right? Because every assets, time is money. So by holding your assets temporarily, they actually can lend your stock and lend your cash to pension funds, to hedge funds who want to short the stock market, right? When you go to stock market, when you short something, you need to borrow from somewhere. Who is lending that? It's actually many of the retail customers who are waiting for the settlement time and then be lended. And we're talking about $20-30 million of fees being made on these waiting time interest. So that's another example. And we have more, we have Kickstarter, who's charging 8 to 10%, and you realize they're not doing that much anyway. It's just a simple platform. And then you have the other category and then usually these two things kind of combined is you have excessive margin over complexity, yet they still somehow dominate the market, likely because some kind of regular hurdle, right? So for example, in the financial market, heavily gated by all kinds of licenses. They just can't be a broker easily. So that kind of helps. And then you have market incentive failures. You have commercial banking, social networks, et cetera. So generally, I think that's kind of one of the angle, at least the kind of thought framework we use a lot in String Labs, and thinking about what are the interesting opportunities. There are lots of things you can do, but as the saying goes, the future is now, but it's unevenly spreaded. And I think the same thing is going to apply to decentralized space, is you realize they can do everything, but not a lot necessarily makes sense at this time point, right? So you kind of wanted to serialize what exactly is the sequence of things that will unfold. And I think that's one of the lens we use a lot to think about these problems. What are the things that are most corrupt in trust, what have the most excessive margin, yet can be easily replaced by peer networks? So let's look at one concrete example, thought experiments. So Uber, the most broken kind of excessive margin, but maybe it's not actually too much. They're maybe not necessarily making too much money. In fact, they're making a huge loss every year. So where did exactly the money go? What is wrong with their business model? So Uber raised about $15 billion in total, probably the most well-funded private company ever, right? And probably a public company as well. So they spend multi-billion dollars, mostly just in marketing and driver subsidy, right? Because they have to fight global wars. I'm not sure if you guys heard of that, but recently Uber just lost their China war, right? Their China subsidiary after spending $2 billion or $3 billion, and they sold the company to their rival Didi in China. That's an example. And what they're mostly spending on, like Uber China doesn't really necessarily even have a product team. It's tiny, right? It's mostly just operations team, city by city by city by city, and then just tons of ground marketing, and then plus massive marketing subsidy. Basically give $500, $1,000 to drivers who are signing up from their rivals. So that's one major expense. The second thing is spend tons of money on fighting lobbying globally for each city, right? And you still see Texas and Paris and London, all these cities who are not happy with that. But again, it's possible only because Uber is a centralized company, right? If they were not a centralized company, it wouldn't be possible. And the third thing is, the reason why they have to spend so much money on loyalty, right, on driver loyalty, is ultimately because they are treated as hourly workers, right? They're not employees, they're not well treated, and they don't have much incentive to really help Uber, right? So if you go to an Uber driver, typically they run 2 or 3 smartphones running Lyft, Uber, and then maybe something else, right? That's very, very typical. And that's a sign of low loyalty. That something might be wrong, that maybe the incentive scheme is just not correct. So you see Uber had a collection of a few problems. One, it's spending way too much on marketing subsidy. It probably should actually change the loyalty model. Number two, it's spending way too much on lobbying, right? You have a global lobbying team, probably hundreds of lawyers. Maybe it shouldn't be a centralized company fighting against the world. So if you imagine a decentralized Uber, it would be a little bit different model. First of all, it wouldn't have so much money, obviously. It will likely be probably crowdfunded. If crowdfunded, it will be like in millions, 10 millions maybe, but definitely not in billions likely. But one thing that Uber has a massive advantage over the centralized Uber is, first of all, it doesn't have to necessarily fight lobbying wars. Well, thanks to Uber, they already does some good job. But secondly, the protocol itself is not even regulatable, right? The drivers may be stopped individually, but it's much harder to stop a whole city, right? So we're talking about a much less or doesn't even exist regulatory cost. On the other side, you could also swap the subsidy for the drivers with actually treat them more like partners. Right? They could have participatory tokens that actually they own in the protocol, which will benefit them. So I think there are a bunch of posts on tweets talking about the circular economy, right? Basically, you as a partner or service provider to the protocol, you earn some tokens. That tokens benefits you and benefits the whole ecosystem and incentivizes you to continue to promote it, evangelize, and et cetera. So that's kind of an interesting example and a rather simple example. Uber isn't really doing anything fancy. It's really just matchmaking between driver and passenger. It's a marketplace, a two-sided marketplace, right? If you're going to create a protocol, there may be a bit more complexity and nuance there. For example, you would have to offload some of the job of Uber selecting the right driver, onboarding the driver, reputation management. There's a couple of complexities, but it's still doable. It's not massively complex. Another example, something we work on quite a bit, is commercial banking, a more decentralized commercial banking world. But we can start with the simple version, the original version of commercial banking. So I don't know how much of you are familiar with the finance world, but generally one of the key things that commercial banking do is to create money and create good loans, right? And they're actually the two sides of the same thing. So whenever you go to a commercial bank, they create a new loan, you say, okay, $10,000 approved for your loan, car loan or something, and they have a lien on your asset, on your house or something. At the same point, they have created a net new purchasing power. They have created new money out of thin air. That $10,000 doesn't come from Fed or come from anywhere, it comes from them, right? They have a special power to create new money. And that money is a debt. So you have created an asset and a liability. The asset is a loan, that's your principal plus your interest, and the liability is their credits to you. So think about that banking model. And we have seen many cases in the history of commercial banking failure, but the most recent one has a lot to do with a failure of rating agency. If you watch a Big Short movie, it's a real interesting one. So it talks about how there are a bunch of people who, hedge fund managers, et cetera, who predicted some of the failures of that. But a key failure in that model is every time when a commercial bank creates a package of loans, to create a new loan, and they pull them together into something called MBS, mortgage-backed securities, right? And one of the things they do is obviously you need a rating agency to rate them. Are they risky? How risky they are? Are they AA rating, BB rating, et cetera? Standard & Poor's, Moody's, all these names you might heard of. But the problem is, what exactly is the incentive for these rating agencies? Theoretically, they should be doing a good job. They earn a good reputation. Everybody trusts the rating, and therefore they buy more of the research reports, et cetera, et cetera. And they get fees. The only problem, though, is they get fees from their clients. And who are their clients? Their client is commercial banks and investment banks, right? Who are asking them to rate that. So you see that's a conflict of interest, right? A simple problem of conflict of interest, where if I rate your loan, not particularly if my client wants an AA rating and I give him a B rating, he's probably not going to come to me, and he probably knows that there's quite a few alternatives on the street, on Wall Street. So he's probably not going to come to me, and that's a simple conflict of interest. And obviously, the other thing happening with commercial banking is since the 1980s, if you read the first serious book of Michael Lewis about Liar's Poker, right, a classic. So Liar's Poker talks about when he's in Salomon Brothers, which was his first job on Wall Street, how there's a massive securitization of the loan. So it used to be, if I create a loan as a bank, if I'm Chase, I create a loan, for example, to Chris, right? Chris, just took a mortgage. I'm taking a balance sheet risk, right? Meaning if he defaults, right, I'm actually taking a hit on my equity, on my shareholder equity. So I'm losing money. That's a risk. Now, the securitization mechanism is that such that you can pull a bunch of loans, you can sell off that risk to someone else. For example, a pension fund, right? Pension fund is usually pretty wealthy and well-funded, so they can, $100 billion scale. They can easily buy large amounts of securitized loans, not necessarily knowing exactly who is within that loan or how high quality that loan. So that's another thing that's happening with the commercial banking. So you have a number of these factors that combine that makes the kind of the whole model rather incentively incompatible for a good, healthy ecosystem. You have securitization, which makes it very easy for someone to create a bunch of bad loans, right? As in the Big Short movie, the stripper who is, borrowing money for the fifth house, who clearly cannot pay for that, right? Then you also have the failure rating agencies who is helping these bad-rated, these low-quality loans, subprime loans, and rate them very highly, right? So they create tranches of loans and give them each, a overinflated rating. And then finally, you also have the failure on the commercial side. So with all that risk that the consumer is taking, yet they're not compensated well for how much risk they're taking. If you put $10 into Chase, you're actually taking a risk on them, that whether they will be solvent or not, right? So we do, and ultimately, obviously, they could socialize their loss and et cetera. So anyway, so that's the kind of commercial banking, and the government kind of compensate that with a bunch of very complex regulations and et cetera. Now, fast forwarding to the P2P lending world, right? P2P lending was supposed to be as a mechanism to solve some of the problems, at least, for example, to provide consumer an interest, right? So now, finally, we're removing the big banks and saying, okay, I'm going to just match Chris's loan with Martin's money, right? And Martin now can earn a 10% interest. That sounds great. Now, again, however, you replicate the same incentive problems, though, as the commercial bank partially. The platform itself, like Lending Club, if you go to Lending Club, right, today, they don't take a risk, right? All their job is just to matchmaking between someone who want to invest and someone who want to take a loan, right? So if you lose money, theoretically, yes, they want to have a good reputation, they want to protect the platform, but ultimately they don't have any skin in the game, right? It's like a proof of stake problem in the classic proof of stake problem, nothing at stake. So, however, these problems and you realize actually the whole mechanism isn't really particularly complex. The fundamental failure is incentive problems. So we can actually fix that reasonably straightforward with certain techniques in a smart contract system. So in a very highly simplified concept of FI, decentralized commercial banking, you can create a different class of people. You have investors, you have people who are borrowing money, but you could also have a separate independent people who are loan validation agents, right? So these people could, for example, put certain amount of deposits on chain in a smart contracts, right? So the FI DAO or the FI protocol could lock a certain amount of money and then allow the agents to independently rate all these loans. See how trustworthy is Martin? Is he possibly able to repay the loan? And you can have independently a number of agents to rate that. And all of them are incentivized or disincentivized by creating bad loans because all of them have deposits on chain. So you have certain simple techniques that can solve these problems. So I'm showing this as an illustration of how protocols are fundamentally designed not simply because they're smarter, they're just computer programs. They're not any smarter than any of the programs, but they can solve problems that are failing in market incentive, run incentive designs. So, for time reason, we'll just probably summarize a little bit about what are some interesting protocol patterns that are happening that you could design on chain. You could have a decentralized organization that, for example, like Colony, which can allow you to create better coordination mechanisms. You can have certain protocols that can self-capitalizes. So the protocol, for example, like one of the things that KCD Troll, who actually made a presentation last year at DevCon, about automated smart markets, right? So smart market idea, a small part of the idea is you having a robot who is working on chain to create liquidity. So one of the fundamental problems with financial exchange, to bootstrap financial exchange, is where does the initial liquidity come from, right? Someone has to make the market. So in this case, for example, you could use an on-chain construct like an automated robot who has a bunch of money. that comes from human or comes from processing fees, et cetera, and use that money to liquidate, to make the market more liquid. If there's no one taking that sell order, the robot can take it, right? So these kind of interesting constructs. And then you have marketplaces, which is very common, I think, for different protocols. And then finally, there's another interesting part. It's called on-chain and off-chain hybrid systems. So in many ways, for example, back to the FI example, you wouldn't necessarily, like ultimately what exactly is the incentive of the borrower to return money to the investor? Well, ultimately it has to be constrained by a legal system, right? So now the interesting question is how do you combine on-chain and off-chain systems? And you could imagine in different ways, there could be a certain legal components, a legal contract that the borrower could be signed. And in that legal contract, it states, okay, the status of this loan should be decided by the state of a smart contract, right? So you could actually have almost like a reverse oracle, right? Like a traditional oracle, everyone familiar with the concept of oracle, right? Is you have a smart contract which takes information from external world. But the same thing could happen, obviously, in opposites. You could have a real world entity who has a bylaw, corporate bylaw, or a certain contract among the different entities, and they could be taking a signal from the state of the smart contract, saying, okay, if the smart contract says I have 10% shares, that will be recognized in the legal world. That company, I would actually own 10% of shares, right? You know, simple constructs like that, which makes very, very powerful systems. And I don't think there's necessarily an exclusivity that you have to do everything on chain or everything off chain. There could be very nice hybrid systems. Okay, so we'll just probably just close the first part was open protocols is great. It gives you lots of powerful mechanisms. It helps you to fix incentives problems. It can help you fix excessive margin. You can create very efficient protocols that are taking massively lower marginal costs. Like the Uber example, you could take a 1% fee instead of 25% fee. And that 1% fee can be used to funding software development on the Uber protocol itself, et cetera. But there are also certain challenges. You have slower technical evolution. You also have a more kind of general problem of diluting responsibility and incentive, and I don't think we have a perfect answer to that. It's in general because everybody owns a small portion of a token, unlike a startup where a typical founder has 20, 30, 40, 50%, and the early team has a huge chunk of the company. And if you do make it big, like Uber, you're going to own a huge part of the unicorn. So I think there's a trade-off here. The trade-off, I guess, is traditional startup, you have a very long cycle. A typical VC fund, for example, is 7 to 10 years, right? So you're expecting a company to spending 5 to 10 years if they even survive at all in the first place, and only a tiny portion of them will become unicorn, and then you own a huge portion of it, right? So you're going to be $100 million net worth. So that's kind of the traditional logic, but we're talking about 1 in 10,000, 1 in 100,000, whatever. In the kind of protocol world, it's a bit different. You trade off the low success rate for a much higher success rate because you have a larger network, you have a lot more contributors who are initially involved. But on the other hand, each of the people own probably a smaller part of it. You know, just like Ethereum, Vitalik owns 1% or something, which is very different from the traditional startup world. So there are different changes in kind of expectation. And then also there's always the challenge of public protocol governance. You never know who gets into that. Okay, so that's part one. So that's kind of the interesting thing about how do we think about protocol opportunities. There's also what exactly business model does it create? So if we're going to take a step back and look at what does the startup world look like today, it looks something like this, right? These are like the hottest startups and entrepreneurs. And in general, you would find an interesting pattern. They're not completely representative of the whole startup world, but they're kind of representative for a certain big segment of it. They are generally business model-centered entrepreneurs, meaning they don't necessarily have a deep technical kind of proficiency. The company doesn't necessarily have deep technological innovations, but they're extremely good in operational and business model innovations, right? Uber belongs to that. Alibaba belongs to that. Like Jack Ma was an English teacher before his startup, right? He has zero technical exposure. Out of his 18 people first initial founding team, I think more than half of them are non-technical. They're like English teachers, police, cops, all kinds of weird professions. But one of the things they're very good at, always been very good at, is extremely good in sales, very good in operations stuff, good in strategies, right? And business model strategies. We're not talking about deep technology innovations. That obviously changes, as Alibaba grows, but fundamentally their gene is a business company. And then you have Tencent, which controls WeChat, right? One of the most valuable social network in the world now. who is again an engineer, but much more heavy on the business side. You have Brian Chesky, who is a designer, very business focused. Airbnb is not really about technology innovation, right? They have great user experience, but it's more about business model. Reddit's a much smaller company, but it's kind of Reddit is the front page of the internet, so it's kind of an interesting example, iconic example that Steve Hoffman is a designer again, right? There's not much engineer and kind of ish to the whole gene of these companies. Now, what is common about these things? What did that tell us? I think it tells us a couple of things. One is what exactly is how do they defend their business model? How do they defend their network? They defend by a couple of things. Network effect, the fact that all of them has very strong, generally pretty strong network effect. Uber has reasonably strong network effect. Airbnb has probably a more stronger, but general, that's kind of thing happening. And then the second thing is topology ownership. So I use a term to express that basically they control the structure of the networks, right? So if you're running Facebook, if you're running Slack, you not only you control the entry point, you control the who is in and how can they create their sub-networks and et cetera. So you own the whole topology, not just user data. You own the structure of the network. Really powerful. Third thing, they also have platform ownership. Many of them involved to be a platform, right? Platform is something that you can build on top of it, and they own the entry point and exit point again. Classic example is LinkedIn. When LinkedIn shut down their API back in 2011 or 12, a bunch of companies went bankrupt, right? Just by that move alone, they have destroyed a bunch of companies. Like Relate IQ, I think was sold to Salesforce, sold to Salesforce just a few months later. For a much cheaper price, and it would probably be worse because they have cut off an important data points, right? So that's kind of giving a sense of what a closed platform or semi-closed platform versus a open platform, the difference, right? You control the fate of a number of ecosystem players around you. And the last thing is regulated advantage. Many of these companies have huge regulated advantage. We're talking about war chests of billions and billions of dollars and regulated relationships that are basically impossible to surmount for new startup, right? Unless you have $10, $20 million, it's not even particularly practical to create any fintech business in general in the US, right? So we're talking about a huge amount of regulatory advantage there. So these are the four main things that we would observe that kind of defend each classic business model. And we'll probably, there's a kind of different summary from Peter Thiel. Anyone probably read From Zero to One will recognize this. He talks about two main viewpoints. One is monopoly is a condition of every successful business, not particularly surprised, but interesting summary of how to see it. Second thing is the best entrepreneur know this, every great business is built around a secret that's hidden from the outside. When he uses the word secret, he means, I think, pretty broadly. We're talking about portfolio of secrets like data, user data, patents, algorithms, network topology, platform ownership, all of that, right? It's certain thing that only you can control or only you know, but other people wouldn't, and you wouldn't want to give it away, right? Once you give it away, you lost your business model defense. So that's kind of a traditional way of looking at it. You generally code things. How does that compare to open network? Open network is almost the opposite of it. You have a complete public topology. You know, at least right now, on Ethereum network, any smart contract, DAO, you basically can check everyone pseudonymously, but at least you know exactly who owns it. You can even replicate the DAO state, and you create a new DAO, right? There's almost no defense at that level. You also have permissionless less platform. So if LinkedIn were to create a social network on a blockchain, they probably don't have the ability, or if they design properly, they wouldn't have the ability at all to shut down API access, right? It's just there. You can control it. And the third thing is the regulated shift, the burden shift to the edge. So traditionally, the regulated burden is at the center. If you're Coinbase, if you are PayPal, you spend 10 years fighting for money transmitter license across 49 states or something, right? That's the kind of regulated advantage you have. And you actually like to lobby for more regulated barriers, right? So your competitor cannot overtake you. But that's very different, right? Now the regulated edge is no longer, you no longer control the topology, and therefore you may not even be in a regulated business at all. And therefore, it's not a barrier, neither a advantage. And then the network also, because of all these structural changes, network effects still exist, but a little bit different, quite a bit different. So, but generally, you could summarize it. The new strategy, in fact, is to be radical openness, right? We're talking about radical openness in every single level. We're talking about state, logic, development, company philosophy, the way you organize your company, how fluid your team members are. All these kind of things impact it hugely. So one of the things I think might worth talking about is a little bit about network effect. So network effect apparently is a theme, common theme that across all the different business models that we talk about. And so we use that term a lot. We don't necessarily have a formal definition of it. So I think it'd be interesting to actually formalize is the way how we analyze network effects. What are network effects like in different business models? So there's two famous laws in generally about network effects. One is the value of a network proportional to the square of, typo here, of connected users. A simple example like Facebook, right? The more users you have, the more squared value you have. Reed's law is in a subgroup, like Slack and Facebook groups, the more easily you allow people to create a subgroup, the value of the network massively increases, right? So they're kind of related, but in a different way. If we further divide the type of network effect in different types of structure, there are three main types. The most simple one is a simple one-tier network, like a Facebook, right? Everyone is a user, at least in the beginning. Everyone is my college, peermates, classmates. Interconnected set of people or devices. And it could be a device as well. It doesn't have to be people. The second type is marketplaces. So I used to work at a eBay marketplace for a while. And it was an interesting experience to see how a fundamentally zero inventory, zero warehouse company created massive value and able to hold that massive value even when their technology innovation is falling massive behind. And you can see network effect is, just basically in there. That's the main thing that is driving the whole business. Craigslist as well. Craigslist haven't changed it for 10 years or something, right? And it's still, a valuable company, unfortunately. Most of the most popular classified service. And just tells you how powerful even a two-sided network, two-sided marketplace can be without much technical innovation, just by the network itself. The third type is platform. So you have more complexity. You have not only necessarily have a marketplace, but on top of that, you can have a platform. And all these things are not necessarily exclusive or mutually exclusive. You can have multiple. For example, Facebook is a simple evolution example of that. You start with a simple network, a bunch of people connected on a network, uploading photos, etc. You make it a marketplace by adding the advertisers, right? So the advertisers now matches with some of the users, right? So it becomes an advertiser, and you serve the both sides at the same time. And then it evolves further to become a platform. The platform becomes, this open platform that developer can develop applications, games, etc. on the platform. So you see that network effect being weaved into multiple layers over time. That's one way of kind of increasing your network effect strengths, right? How defendable you are. Because now if you wanted to challenge Facebook, you have to challenge so many different layers. You have to challenge the advertiser network, you have to challenge your user base, you have to challenge the developers, utilities, et cetera, et cetera. So that's kind of an interesting way of analyzing how the strengths of it. Now, if we back to a little bit to our open protocol world, how defendable is open network? So as we see from the previous comparison, they lost some of defendability, right? So now anyone can copy the whole state. So you don't necessarily have a lock-in to my user, right? If I create Facebook on blockchain, the Facebook, every single user on that network would have their identity, their reputation, completely encoded on a blockchain. If I wanted to launch a better network, all I have to do is just copy the state. Simple. So there's not topology level control. However, what you do have is a coordination. Things, for example, if you're running a financial exchange, you have a liquidity, right? So you could have people who are generally hooked up into the same exchange. You can expect that if I issue a $10 million order, I know this big exchange, like NASDAQ or whatever, equivalent on chain, would able to execute my order. It would take my order at a better price than anyone else, right? So there's a liquidity. There's certain defense of that. It's not necessarily particularly strongest, but it's there. The second thing is if you're a platform like Ethereum, you certainly have developer support, right? You see a while ago, everybody tweeting about I'm 100% behind ETH or whatever, right? That's kind of the thing that shows basically the network effect is trying to form and show to the world that actually there are lots and lots of developers behind it. That's valuable. And then the third thing is ecosystem. So if you have service provider support, you have off-chain components, which is strong defense again. If you run, let's say, UPort identity or something, someone has to run these passport checks and something, right, for every single country. You might have a US identity provider who's checking the passport. You have a UK provider, et cetera, et cetera. All of them is part of the ecosystem. And these people would have to be connected simultaneously to the same network. So that's another level of further defense. So that's kind of a few examples of how you can defend an open network and still incentivize you as a developer and entrepreneur while making it still open. So it doesn't mean it's the end of the world just because it's open source, just because it's open state. So to summarize it, the main business model for open protocol, if you're an entrepreneur today, the couple of things you could do and you could do multiple or all of them, and that's basically like you could do things like you launch a new protocol, you realize there's a vacancy in supply chain, you launch a new supply chain protocol which coordinates across trade financing, right? That's great. You could also become a service provider to the protocol. You realize you launch your supply chain system, but there's not much funding. Why don't I bootstrap this system? And I can loan the money to all the supply chain eco providers. So I bootstrap, inject $2 million from my venture capital or money that I raised. And you charge a fee, right? That's a service provider model. You can build on top of the protocol. You can create mobile application. You can create hardware. You can create a bunch of things around it. I think all of them are valid business models, and Streamlabs, for example, do all of them. We bootstrap a bunch of open protocols. We also become service providers. We do certain financial mining, right? A bunch of them. I would say, except with one exception, is I think I would consider a fallacy, a dangerous thing to do in this space, is you pick a model that you try to control the whole networks, yet you run in the decentralized space. And unfortunately, that's happening quite a bit in the last 2 years, I think, in the blockchain space, is people apply the same startup model of being a centralized controller, like a SaaS model, right, in the decentralized space. And that's kind of get to the worst of the both world. You got all the regulatory burdens, you got all the danger and the risk and overhead, yet you don't get much benefits. I think that's the only thing I would suggest people to avoid. There obviously need to be certain people who are taking operational overhead on the edge, but it doesn't mean that it's necessarily a preferred, a optimal model.
Who would you put into that category of that trying to be a centralized controller and decentralized?
For example, like Ripple, but Ripple, again, if you treat it as a public network, I think that would put them at that kind of centralized controller, right? They control 90% or 95% of XRP, right? They control the whole network software, et cetera, et cetera. They run over 2 servers or something like that, right? So that's a typical centralized network. But obviously, if you're position them differently as a private chain operator for banks, right? Maybe that's okay, right? But we're not talking about public networks, depending on how they position themselves. And I think that's some of the transition we're seeing them happening, basically. They started with a public network, yet a centralized model, right? That's pretty bad. And you got a bunch of fines from FinCEN, unfortunately, because of the public network, right? They got a $1.3 million fine, something like that, right? Because they don't have a money transmitter license or AML, KYC program, et cetera, et cetera. Yet you don't get much benefit of a traditional operator, right? So you'd rather just be a PayPal, right? I mean, what's wrong with that? You actually have much simpler. You don't even have they also failed with one of their consensus protocols, right? So they have to reboot the whole thing. So you basically lose all the advantages, yet don't get much of the benefits back. Does that make sense? Cool. Any questions so far? Yeah, that's right. So I mean, that's one of the trade-offs that we're accepting, right? The Bitfinex hack, Mountain Gox hack, all the things that are happening is we usually end up taking more responsibility. I suppose the general rule to that question is, I suppose, is when you think about Uber or a marketplace operator or like eBay or PayPal, they're bundling like 50 different responsibility into one company, and that's why they're valuable, and that's why they charge you 10% or 15% fee. I think, and they overhead you, right? So they don't necessarily give you a choice. I only want customer protection, but not that claim customer service, right? Something like that. So you don't have that choice. And I think the question in decentralized protocol design is you could still designate certain type of actors, like an insurance provider, into the protocol, who is giving you a claim. You can have a claim if you run into a bad driver, right? You can still have that kind of responsibility, but you can optionally select that. You can also unbundle it to multiple type of actors, so you don't collude with each other, et cetera. But I don't think there's a perfect answer to that. In some cases, you might prefer to call a one 1-800 number, right? That you can solve everything. But I think the cost of that, you have a much too powerful network operator who is making probably too much commission. So I guess there's a cost to that as well, just like your insurance anti-fraud charge, right? Same thing. Yeah, good question. I mean, part of the work that we doing, and we're going to probably reveal a little bit later in DEF CON, is about some of the decision system that we use for public network governance. That's a critical one, because if you're being taken over by a malicious attacker, I mean, the system wouldn't be particularly valuable. So yeah, it's a huge part. And there are way better ways to do that than like DAO or some of the example that's shown. There are better ways. Since like liquid democracy, more fluid decision system, et cetera.
But it's impossible for you to build the trust that the centralized network is lacking if you don't have an answer
Yeah, we do. We do have certain answers. I think the way is, yeah, I guess in general, the DAO, for example, is you have a simple voting mechanisms, right? And that's not the only way to do it. There's a lot more sophisticated way. Liquid democracy be one of them. Is you could delegate certain. You still have the speed of reaching fast decisions, high quality decisions, without necessarily delegating to one central people, right? You don't have to delegate to one company, but instead you could have delegate to a trust graph, for example, one of the texting we use. And it's completely opaque. Yeah. Yes.
So I have a question about when defense strategy comes to the liquidity aspect of the platform. My question is, how good is this defense strategy really? Because to some degree you can also copy the liquidity. So if you would, I mean, for currently eBay, defense strategy is liquidity network.
Yeah. Yeah.
But if it would be on the blockchain, you could just create something that kind of taps into
you
that
could.
liquidity, but has in addition that, and then it was like kind of the old days when WhatsApp got started. So if both parties are on WhatsApp, kind of on the free platform, then they can just communicate directly with without fees. But if the other one doesn't have WhatsApp, it's on the old eBay platform, then you will just do the SMS and pay the fee.
Yeah, that's right. I think there is generally especially if you charge like, excessive fees, right? If you charge 10%, I'm pretty sure there was something will come out 1% Gnosis, and that kind of do the same thing, basically, the same state, the same user, etc. So I think that's right. I think that's one of the reasons that I think generally these massive networks have much lower margins. Will likely have, that's my kind of a personal guess, it will unlikely to have the centralized eBay world of the world, right? You're not going to have 15% fee to start with. You're going to start with 1%. You might even lower to 0.1% because some stronger competitor who just copied their state, right? And with a reasonable development efforts. I guess there's one constraint. It's almost like one of these mining costs, right? How low can mining cost go is marginal cost and marginal value, right? So if you're going to continue to drop until to the point where it doesn't even make sense to support the development ecosystem. So if you charge it, let's say, 1% fee, and if that fee is just about to cover the reasonable development team, like 5 or 10 people, that's one of the limit that will hit, because any other team will likely hit similar limits, unless someone do it more massively efficiently. So I guess that challenges the fundamental model that you can just sit on one protocol invent, and you continuously just make fees for the lifetime, right? Extremely unlikely to happen in that open protocol world. For simple example like Craigslist, honestly, I think it should be free, and that's probably my answer to it. Is I don't even think it's worthwhile charging for such a crappy service, right? It's a very basic service. Now, where does that funding come from? It could come from the goodwill developers, open source developer, which we know there's a lot. It could also come from things like a common development fund, right? There are certain commons, right? There are certain public goods that should be developed and supported by a fund, a better version of DAO, right? The DAO that could allocate, certain 10% of it to ecosystem public goods. So it doesn't have to be, you don't have to monetize on every single thing that you create. I think that'll be the answer. I think there's some misconception. I suppose there is a platform involved. It just happened to be smart contracts with coordinating all the rights, right? So the smart contract coordinates the payments, right? On the arrival, there's some kind of proof of arrival or something, proof of distance or something that actually basically swaps the money. So there is. Sorry, should we move on for time reason, and then we can?
I mean, you were talking about not wanting to have something part of recorded, so
Yeah.
community are made for this.
Okay, cool. Yeah, I think that's probably that's it for this part.